Hello, this is Tim Congdon, Chair of the Institute of International Monetary Research at the University of Buckingham. It's May 2023, and I'm giving the monthly discussion of money and monetary trends around the world. But as so often, I've been distracted by policy issues and the matters in economic theory and so on that affect these subjects. At the end of last month, I brought out a pamphlet through the think tank Politeia in London about British inflation, why had it gone up and what had gone wrong, and in effect asking the question, how far was the Bank of England to blame for the rise in inflation to double-digit levels last year? In order to see how I answer this question, I just want to go through some background, some of it on my own career, which began in the early 1970s. I'll do some of that and then explain the quantitative theory of money, monetarism, and then I'll say a few things about a speech given by Ben Broadbent, Deputy Governor of the Bank of England, to defend the Bank of England in this episode. I started to get interested in money in the early 1970s when my first job was on the Times in London, where it was a very fascinating time. The Americans ended the link between the dollar and gold in 1971. And Britain went on to a floating exchange rate in the summer of 1972. I say a floating exchange rate, but it wasn't really, it was just a fall. And the fall in the value of the pound on the foreign exchanges was followed by a surge in inflation. What was really going on here was that at the end of 1971, there was a major liberalisation of banking in the UK, and banks grew their balance sheets very rapidly. And for a period of roughly 2 years, until the end of 1973, the quantity of money surged by about 3/4, annualizing typical rate of growth around about 30% a year. There was a massive boom, surging house prices, strong stock market until spring of 72, and then inflation took off. In fact, inflation peaked in Britain at about 27% in August 1975. Now, these events persuaded me that there was something in the relationship between money and inflation, and it's coincided more generally with the rise of interest in monetarism led by Milton Friedman. Now, monetarism only has two central ideas. One is that there is a link in the medium and long run between the rate of change of the quantity of money. Broadly defined, please, I won't go into that too much now, but broadly defined, and the rate of growth of nominal GDP. And given that the rate of growth of real output is usually fairly modest, 1%, 2%, 3% a year, there's going to be a link between money and inflation. And then the second idea is implied by this, which is that to defeat inflation, it's necessary to maintain control of the quantity of money. And Milton Friedman advocated in some work in 1959, well before 1971 and the surge in inflation, he advocated a low growth of money to defeat inflation and stable growth of money to keep the economy growing steadily. These ideas appealed to me very much as a young man, and they still do. And I think it's just worth noting here that in his work back in 1959, Friedman's recommendation was very much in terms of broad money, which has also been the theme of my career as a defender of what you might call broad money monetarism. This helped me in various episodes through the 1970s, 80s, 90s, and so on. And I've been a regular commentator on this very important relationship that's so important to inflation. Now, rather curiously, in the 2010s, Friedman, 1959, said that USA should have roughly 4% growth of money to keep price level stable. 4% growth of broad money. We more or less had that in Britain in the 2010s. Now, the trend rate of growth of real output was rather disappointing, about 1.5% or so, but that so meant we really had a lower growth rate of money. We had roughly, in fact, I think it was 3.8% a year in the decade to the fourth quarter of 2019. So output rose by about 1.5% a year. The ratio of money to GDP didn't change very much, and inflation was bang on target at 2%. You could, if you wish, call this the Great Stabilization after the Great Recession. I was hoping this would carry on forever. It was really quite pleasing in a way what was going on. But then, of course, we had COVID in 2020. And this is the chart of money growth in this period going back to 2011. You can see that stability through the 2010s. Inflation, on target inflation, everything okay. And then this leap in money in 2020, and coinciding, of course, with a collapse in nominal GDP in Q2 2020 because of the COVID epidemic. And my forecasts then were all based on what I'd gone through in the previous 50 or so years. I said there'd be a lot of inflation. And just to we get this clear, we had in effect a kind of great destabilization after the better performance in the 2010s. And the surge in money was partly because of the monetary financing of the large budget deficit associated with the COVID epidemic, but it was also because of large purchases of assets, mostly government securities, by the Bank of England, so-called quantitative easing. It's not very difficult what's going on. Essentially, the Bank of England buys something, anything from me, sell it to government security, whatever, my bank deposit goes up, the bank deposits some money. So in spring 2020, I warned that there's going to be, spring and summer 2020, I warned that there's going to be some inflation. And let me just, to get this clear, I said, talking about the UK, that I'll be surprised if the current mix of policies is not accompanied over the next few months by an annual increase in M4X, that's the critical monetary measure, into the double digits. I will also be surprised if that does not lead to an inflation rate closer to 10% than we have seen for many years. I said something very similar, by the way, to the House of Lords Economic Affairs Committee in February 2021. And I said there that the rate of money growth had in fact moved up at that point to about 14%. The trend rate of growth to the British economy in real terms is not much more than 1%. There's a huge imbalance between the 14% growth of money and the growth of output. It'll come through in inflation. What is happening at the moment in Britain is very irresponsible within the context of a theory in which we relate the price level to the quantity of money. Now, of course, in practice, the rate of money growth peaked at 15.4% exactly then in February 2021. Inflation stayed down for a bit, not, by the way, the rate of increase of house prices, which surged in early 2021. But the inflation then really took off in late 21 and 22. Everyone says that it was the invasion of Ukraine that hit energy prices, food prices, and so on. Yes, of course, to some extent that was the occasion of it wasn't really the cause. The cause was that inflation was due to excessive money growth. Asia was also affected by events in Ukraine. Asia didn't have rising inflation. In the work that I've just done, this pamphlet I brought out at the end of last month, I concluded by saying that money, the behaviour of the growth of the quantity of money, should be watched by the Bank of England, and indeed that central banks that don't look at money will be as dangerous, as badly informed, ignorant and dangerous as drivers who never look at the speedometer of their cars. All of this, of course, has had some effect on the public debate, and there's been a reply from the Bank of England. Ben Broadbent, who's Deputy Governor in charge of monetary policy, gave a speech a few weeks ago to the National Institute of Economic and Social Research. And I want, in the last few minutes of this video, just to reply to some of what Broadbent has said. He sets up his speech as a discussion between, do central bankers look at the quantity of money, or should they watch the rate of interest? Is it a matter of prices or quantities? I think this is to some extent an artificial opposition of these ideas, but anyway. And he defends the bank really with only one factual example. Only one. And by the way, there's no positive evidence in favour of looking only at interest rates at all. None at all. And the one example he gives is a contrast between the years before and after the Great Recession. Before the Great Recession, there was quite fast growth of money and still inflation of 2%. And then after the Great Recession, there was again 2% inflation, but money growth was much lower. So you get this contrast between these two periods, one with fast money growth, 2% inflation, other with slow money growth and 2% inflation. So on the face of it, how do I answer that? What, does this mean that the theory is wrong? Well, let me first of all just sort of give, it isn't actually a Broadbent speech, but I'll give these numbers to you now, and just so you can see them. It is indeed true that in the 5 years to the end of 2007, the Great Recession really was from 2007, start of 2008 through to the middle of 2009, 18 months or so period. In that 5 months up to the end of 2007, money growth averaged 8%, inflation was 2%, and the ratio of money to GDP rose by about 3% a year. In the 5 years from the middle of 2009, when Great Recession came to an end, money growth was a bit over 3%, growth nominal GDP was 3%, inflation was 2%, and the ratio of money to GDP didn't change. So evidence looks pretty convincing for Broadbent, doesn't it? Well, let's just look at this period a little bit more carefully. Let's look actually at those 5 years to the end of 2007. And what I've done here is to give you the growth rates of money, annual rate, and the growth rates of nominal GDP. The money is that orange line. Now, and then just so we can see the contrast in the two periods, this is the period 5 years, middle of 2009. Put them now onto a same axes. You can see money growth much lower, inflation about the same, nominal GDP much lower than before though. Okay, let's just look again at that chart, the first one, the period up to the end of 2007. You can see that it really splits into two. There was 2 or 3 years start of 6% money growth, not 8%, 6%, and that was consistent with quite buoyant growth of real GDP. British economy is still growing then, happily, in real terms, and 2% inflation, and then money growth took off to 10% a year. 10% money growth, 2% inflation. Doesn't seem right, does it? Well, it didn't seem right to me at the time. At the end of 2006, I wrote an article in the Sunday Telegraph warning on the blunders of boom and bust. I said, is the Bank of England going to do it again? Are they going to have not only stupid boom-bust cycles? January 2007, I prepared some evidence for the Treasury Committee of the House of Commons, again saying I was worried that excess money growth implied rising inflation. Typically, when the people in charge of policy realize there's inflation, they take action to stop it, and often there's then a recession. So when one's warning about a boom, one's often also warning about a bust in practice. So I gave these two warnings, end of 2006, early 2007, looking at those money growth numbers, saying something was wrong. Well, in a sense, the rest is history. Because, of course, we had then these dramatic events in the interbank market, August 2007, the tightening of bank regulation, autumn 2008, banks shrinking their balance sheets in late 2008, early 2009, QE and so on, catastrophic Great Recession, and then in 2010, rather oddly, but we had the pound collapsed in the second half of 2008. 2010, we had inflation of over 5%. All right? So we had these mistakes in money, this 10% growth of money. I warned there's going to be trouble. There was trouble. We had above target inflation too. Broadbent says nothing about these events in his critique of monetarism in his speech to the National Institute. Let's then just look at this whole period, really, from the 5 years up, the end of 2007, Great Recession period, and then over this whole period, the growth of money was about 1.5% a year, faster than the growth of normal GDP. Very much in line with the typical experience going back to 1964, when the first proper money data were put together. And let's just then look at this chart. Let's look at the messages it gives. First of all, it warned me at the end of 2006 there was trouble coming on the inflation front. In practice, there was a bust as well. You can see that collapse in money growth, collapse in nominal GDP growth. And then you get a more stable period in the 2010s, lowest growth rate of money and lowest rate of nominal GDP for 60 or 70 years. Throughout this period, the money numbers were giving us messages which the Bank of England should have been aware of. They should have been aware of them also in spring of 2020. Now, Mr. Broadbent, I'm not impressed by your speech. And indeed, there is a larger problem here about the inability of central banks to understand the obvious. There is a relationship between money and inflation. It's been proved again in this episode, and the Bank of England needs to sort itself out. Thank you.